Good morning, everybody. Again, my name is Jerry Lynch, and today we're going to go through a couple different things. Again, we've been in private practice for the past 26 years. I've been in investments in financial services for about 35. About a year ago, we merged with OneDigital, and that gave us access to a lot of tools that we simply didn't have before, which helps us help you. So today we're going to go through a couple different things. Number one is I want to take some time and talk about inflation. I see some things that are positive out there. Number two, interest rates that have gone up tremendously over the past year, and I see some opportunities there. Number three, some of the national debt issues that we're facing and its impact on all of us. Talk a little bit about some of the global unrest that we're seeing out there, and really how does all this stuff come back and have an impact on you. So we're going to hit a lot today. So first and foremost, in terms of inflation, my first job out of college was selling vinyl siding door to door back in the 80s. And we would try to convince somebody to use a home equity line of credit at 18% to pay for that. And at the time, that was the norm. Now, historically, you're seeing inflation in about a 2 to 3% range, which is normal. It's supposed to be what's out there because the cost of goods are always going to increase over a period of time. The cost of labor is always going to increase. So that's just a natural thing. But over the past year, there was a huge spike that you see here at the end. But it looks like it's starting to come down, and I see that as being very positive. Rates seem like they're getting more and more under control. So the next thing is that in certain areas of the market, you're seeing that there was greater inflation. So for example, when you go out to the grocery store and you put everything in your cart, you go up there, you're finding it's a lot more expensive in many areas, especially in that area, than it was a couple of years back. We're seeing fuel oil has gone up recently. And again, there's other areas such as used cars and cars in general that seem like there's more volume out there, there's more product, and there's better pricing that are out there. But it looks like a lot of these areas are getting more and more under control, which is a good thing. So when you see this, again, I just want to see the pattern that I see here. I see that there's a rise. If you look back at 2000, there's a plateau, and then there's a decline. And then you hit a bottom, and there's a rise and a plateau and a decline. And that happens over and over again. Now, if you take a look at where we are right now, we've had a very big rise over the past year. I mean, rates were almost at zero since 2008. And right now we saw a spike where now they're over 5%. I think we're close to the top. I don't know if we're at the top. There may be one or two more increases that are coming down there, but I think we're close. We're going to hit a plateau, and then the rates are going to start declining. When interest rates drop, bond prices go up. That's the exact opposite of what we saw last year, where bond prices were dropping because interest rates are rising. But I see this as being very positive for those of you who are retired. And again, most retirees, all they want is income. And if you could get a 5% rate on CDs, money market accounts, treasuries, things like that could give you consistent income, it takes a lot of pressure on what you need on the stock market to get a reasonable rate of return. So I see this as being good. Here, this is also very interesting. So if you take a look at public debt as a percentage of the gross domestic product, that's what we spend as a country. Really, the only time we've had where we are right now is back in the 40s. So the concern I have is that holding debt is not bad when interest rates are at zero. But when you take rates from zero, treasuries, and you basically bring them up to 5 percentage points, your cost of borrowing this money gets a lot more expensive. And right now we have between 33 and $34 trillion of national debt. Now, the problem I have with when I say a million, a billion, and a trillion is those numbers sound very similar. You're changing one letter. How bad could it be? And I use this as an example to help people understand the differences in these numbers. So a million seconds is 12 days. A billion seconds is 32 years. A trillion seconds is 32,000 years. When you start seeing the increase in debt that the federal government has had, again, interest rates went almost from 0 to 5%. A lot of that debt is adjustable debt. So as interest rates rise, it's creating more and more of a strain on the economy. So the bad thing about that is that we got to pay this stuff back. The good thing is this puts pressure on the government to control interest rates because it's increasing the cost of doing business. And that gets back to what I had in that last slide is the rates go up, they hit a plateau, and then they start to decline over a period of time. And again, I see that as a good opportunity for getting into bonds with longer durations where we could lock in these rates for a longer period of time. Again, there's some things out there that are kind of interesting, specifically with China. We've had issues with China with quite some time in terms of the trade imbalances. Russia and the invasion of the Ukraine is creating a huge ripple effect throughout Europe. Again, you have trade that's been disrupted. You have wars that are very expensive to maintain, and it's just been a lot of going back and forth on areas, and it just seems like right now it's not solved. We have the Israel-Hamas conflict, which is basically creating a lot of tension in the Middle East, which also has an impact on the price of oil. So all of these things create some turmoil that's out here. But the one thing I would always say is that there always is something, whether it was, when was the last time you heard of the pigs of Europe? Dealing with interest rates and debt that these people had, or all these different things seem like they're a very big moment at one specific period of time, and then something happens and we go in a total different direction. So I think these things are real issues right now that will take care of themselves over a period of time. And then as we go in, there'll be more things coming forward. But because these things exist, I'm not freak out, because there's always something like this existing. This is part of the process. So how does this impact you? Again, number one is interest rates are higher. So if you have any debt, it's going to cost you more money to maintain that. If you have a home equity line of credit, your home equity line of credit went from probably less than 3% to about 8%. If you have credit card debt, it means that you have a lot more interest that you're paying on the same level of debt you had before. And credit usage has surpassed $1 trillion, which again is a lot of money. So I think that's an issue. Now, again, I think what's happening too is that part of this makes sense, because if it's more expensive for you to go out to the store and buy food for your family and do some of the things that you're doing on a regular basis, it does put pressure on your savings. But this always leads back to, number one, always have an emergency account that's in the opposite side of town on the most inconvenient bank that ever existed. That is your safety net. When something goes wrong, you could get there, but it's difficult to access that money. You must have a foundation in order for your other investments to be safe. Because if you have to sell your investments because the market's down or something bad is happening and we don't have that foundation, it means we lock in a loss. So again, this is part of the process. And I just think over a period of time, save on a systematic basis, invest in all different types of market cycles. Over a period of time, you'll do extremely well. Now, if we take a look at the year-to-date returns, a couple of things I think is kind of important. Number one is that the markets have done reasonably well year to date. I mean, if you take a look at the NASDAQ, it was up 35% over the past year. Now, one of the things I would say is that if we take a look at last year, the NASDAQ was down 33%. So, and if I take a look at the S&P was down 19% year to date. So I think what's important with this, and this is what this says to me, is that we need to be rebalancing portfolios on a systematic basis. The NASDAQ was down because the market was down. A lot of it deals with technology stocks, which were not in favor last year. If we had stayed out of it and said, oh, wow, it's down, I don't want to buy it, we would have lost on the opportunity to get a very nice gain. For those of you, too, that invested systematically through that, if you're in a 401k plan or you're investing in a taxable account on a very systematic basis, you got a very good rate of return because, again, using the NASDAQ, for example, that was down 33% last year. You were buying at a third less than it was the previous year. That is a great buying opportunity. And over a period of time, it's going to do well. But what we're seeing here is that the markets have done very well. Bonds still haven't done as good. But again, what I'm seeing is that the interest rates are finally doing well. And it looks like, again, one of the areas that I haven't liked in the past 15 years, fixed income, is actually looking very attractive, very attractive. Now, so what's the investor outlook going into this year? Number one, key indicators saying there's a recession are showing that the economy is pretty strong. Again, some of the numbers came out today and they look very positive. And the Fed has been using interest rates as a way to slow up the economy. And the economy just keeps fighting and saying, you know what, we're going to do what we're going to do, which is terrific. Bonds. I have not liked bonds in 15 years. We've been in them because it was a stable part of a portfolio, high quality, short duration, but they gave us absolutely no yield. And if you look at the past 15 years, all the portfolio performance was really driven by the stock market. I am excited now about 5% yields that we could get in very conservative treasuries, CDs, money market accounts, which takes a lot of pressure off what we need to do in the stock market to get reasonable rate of returns. And even for those holding tanks that we have right now. I remember a year and a half ago, I was telling somebody we're going to put money into a high yield money market account, and it was paying 0.1%. And the response is that really a high yield money market account? And at that moment in time, it is. Now I'm seeing 5% holding tanks, which is terrific. I'm seeing CDs that are very attractive, treasuries that are very attractive. And I haven't been this happy about fixed income, again, 15 years. So this I see is very positive. Now, on the opposite side, there's some things that are happening that I think have negative. With the geopolitical issues we were talking about, there's nothing out there that seems like it's settling these things. And even when you take a look at some of the issues that we're having internally in the United States with Speaker of the House and some of these other issues, again, there's a lot of turmoil that's happening on a political front. Number two, there's uncertainty what the Fed's going to do. From a business standpoint, I want to know what the deal is. If I want to grow my business and I want to potentially borrow money, I want to know what those costs are. When you have interest rates rising substantially or declining a lot substantially, it makes it very difficult for anybody to be able to plan effectively. It looked like interest rates might start dropping later in this year or 2024. Again, I'm not sure when that's going to happen, but I think we're close to the top. And reasonably, I see that we're going to hit a plateau, and that over a period of time, they're going to start to decline. Number three is higher mortgage rates. So what's the impact on this? You're seeing that right now, if you're looking at buying a home, you're looking at probably around an 8% rate. A year and a half ago, you were looking at probably a 3% rate. That means that your borrowing costs are substantially higher. It means that, again, you went from paying around $400 per 100,000 to borrow your money to over $8 for the same $100,000 of borrowing. That will put downward pressure on real estate. You're taking a look at student loan payments that are just kicking in again, too. And then, again, the auto workers strike. Hopefully, it's getting resolved. I saw some stuff today. It looks like it was going in a positive direction. But again, there's been an impact where a lot of the costs of doing business and or just living have gotten more expensive. And that I see as being a negative thing. All right. So again, I would just say when you have questions, reach out, give us a call. I mean, there's always going to be some issues out there that are going to create market volatility. There's always going to be things that cause change. And our goal is to remain flexible. So for example, again, in terms of what we're doing now on fixed income, we've made some changes there. We're rebalancing portfolios on a systematic basis because I think in a volatile market, it makes sense to take advantage of some of these dips. And we're going to continue to hit you with information that we think applies to you. So if you have any questions, always feel free to reach out. Thanks again for your time. I do appreciate it.